China is absorbing more of the world's silver than global markets can acknowledge, not through public declarations, but through a quiet diversion of physical supply away from open exchanges and into state-controlled channels. The pattern is subtle at first glance, yet unmistakable when viewed against the collapse of available inventories. Global vaults are thinning at the fastest pace since 1980. COMEX has seen more than 37 million ounces vanish in under 2 months, the largest drawdown since the Hunt brothers nearly broke the futures market. Spot silver now trades above futures, a rare condition called backwardation. It tells a simple truth. Buyers no longer trust the promise of future delivery. They want metal in hand today. At the same time, governments and institutions are stepping back from the market. South Korea's largest banks suspended silver sales indefinitely. China blocked its own citizens from buying precious metals through the banking system, a decision that forces more supply towards state reserves. Russia went further, becoming the first nation in over 50 years to designate silver as an official strategic asset. These moves aren't isolated reactions. They're early signals of a market shifting from abundance to controlled scarcity. A market where the largest industrial consumer on Earth, China, is positioning itself ahead of a structural break that others still treat as cyclical volatility. Behind the policy restrictions sits a deeper strategic logic. China dominates solar manufacturing, electric vehicles, battery systems, and electronics, sectors that rely on silver as a non-substitutable input. Industrial demand already exceeds global mine supply, and deficits have erased more than 600 million ounces from above-ground reserves in just 4 years. Accumulation in this environment isn't precaution, it's control. The question is no longer whether China is hoarding silver. The data shows that clearly. The real question is why China is accelerating accumulation now, and what it sees in the coming decade that others do not. This is where the story begins, with a tightening market, a strategic buyer, and a global system slowly recognizing that the world's most important industrial metal is entering a new era of scarcity. Global silver inventories are falling faster than any period in 4 decades. Exchange data shows physical metal leaving vaults at a pace that signals structural stress, not short-term volatility. COMEX alone recorded 37.6 million ounces withdrawn in just 47 days, the largest drain since 1980, the last time the market nearly collapsed under the weight of physical demand. That magnitude of outflow doesn't reflect investor rotation. It reflects scarcity reaching the core of the system. Spot prices now trade above futures, a condition known as backwardation. In stable commodity markets, futures normally command a premium because of storage, financing, and time value. Backwardation flips that logic. It signals buyers are willing to pay more for metal delivered today, not tomorrow, because they doubt tomorrow's availability. This shift marks the early phase of supply stress, the point where confidence in paper markets begins to weaken. The pressure extends beyond pricing mechanics. Banks and institutions are quietly stepping away from silver distribution. 4 major South Korean banks halted silver sales indefinitely, an unprecedented move for a developed financial system with deep access to global markets. At the same time, China restricted retail precious metal purchases, redirecting available supply towards state channels. Russia, facing its own geopolitical constraints, was pushed out of the London market and responded by designating silver as an official strategic reserve asset. Each decision reduces the global float of accessible metal. These institutional shifts unfold alongside a tightening supply-demand imbalance. The Silver Institute reports that 2024 marked the 4th consecutive structural deficit, with global consumption exceeding production by roughly 148.9 million ounces. More importantly, deficits from 2021 through 2024 collectively erased 678 million ounces from above-ground reserves. Those losses represent not investor-held metal, but industrial consumption, metal that is gone permanently. Inventories in London reflect the same trend. LBMA vaults sit near all-time lows as available float contracts. COMEX registered silver, the metal eligible for immediate delivery, has fallen to levels that represent only a fraction of annual industrial demand. At certain points, market leverage exceeded 100 paper claims per physical ounce, leaving the system exposed if even a small percentage of holders request delivery. The structure works only when confidence holds. Confidence, however, is weakening. These developments create a market defined by scarcity creeping through every layer: exchanges, banks, refiners, industrial buyers, and now sovereign actors. The backdrop is no longer one of temporary imbalance. It is the early stage of a physical shortage forming inside a market built on leveraged promises. And this is the environment China is moving into. A market tightening under its own weight, where every ton of metal withdrawn shifts the balance further toward the actors accumulating quietly and early. China's industrial machine sits at the center of global silver demand, not because the country seeks to influence price, but because its economic model requires massive, continuous, and non-substitutable volumes of physical metal. Silver is not optional in China's growth strategy. It is embedded in every sector Beijing considers strategic for the next decade. Solar manufacturing is the clearest example. China produces over 80% of the world's solar panels, and every crystalline silicon panel relies on silver paste for conductivity. This dependence is not trivial. Photovoltaics consumed 197.6 million ounces of silver in 2024, a record level, and nearly 30% of all industrial usage. That number rises each year as China accelerates its renewable build-out and dominates export markets. No other nation consumes silver at this scale for a single industry. Electric vehicles deepen the demand imbalance. China is the world's largest EV producer, and each unit requires roughly twice the silver used in a traditional combustion vehicle. As domestic adoption scales and global automakers source components from Chinese suppliers, silver becomes a structural input to transportation. The growth of EV platforms is exponential. Silver supply is not. Electronics add another layer. China remains the dominant manufacturer of smartphones, computers, circuit boards, and medical devices, each relying on silver's unmatched connectivity and durability. These applications consume silver in micro quantities per device, yet volume multiplies demand across billions of units. The metal embedded in these products does not return to market quickly. Much of it becomes long-term, unrecoverable industrial loss. Infrastructure completes the picture. China's 5G rollout is the largest in the world. AI data center construction is accelerating. Defense applications are expanding. These sectors require silver not for its price efficiency, but for its physical properties. There is no replacement with equal performance at scale. This makes China's demand inelastic. It will not fall simply because prices rise. The result is a structural mismatch between domestic consumption and domestic production. China mined 3,300 metric tons of silver in 2024, yet its industrial usage far exceeds that volume. Imports fill the gap. But as global deficits widen and inventories fall, imports alone cannot secure future supply. This is why Beijing quietly redirected purchases away from households and towards state channels, effectively centralizing accumulation capacity. The policy is strategic, not reactive. When Russia declared silver a formal reserve asset, it offered a glimpse into the future: sovereign accumulation entering a market already straining under industrial demand. China's approach is more discreet, but the scale is larger, the industrial base deeper, and the long-term need unavoidable. China is not buying silver to speculate. It is buying because its technological expansion depends on it. And as China strengthens its control over downstream industries, solar panels, EVs, electronics, its upstream strategy becomes clear. Securing silver today ensures industrial dominance tomorrow. This logic becomes even more compelling once the limitations on global supply come into focus. Global silver supply is hitting limits that economics cannot easily fix. The metal is pulled into multiple industries at once, yet production cannot expand fast enough to meet rising demand. This mismatch has become structural, not cyclical, and it forms the foundation of China's long-term accumulation strategy. The supply problem begins with geology. Nearly 70% of global silver output is produced as a byproduct of mining copper, lead, and zinc. This means silver supply cannot scale unless base metal prices surge enough to justify new investment in those mines. But recent price levels have not encouraged large expansions. As a result, silver output has stayed flat to declining, even as industrial demand accelerated sharply. Primary silver mines offer little relief. Their production fell to roughly 227.5 million ounces in 2024, continuing a multi-year downward trend. Grades are declining, costs are rising, and permitting timelines stretch across a decade. The richest ore bodies were extracted long ago. What remains is harder, deeper, and more expensive to access. No near-term supply boom is coming from the mining sector. Recycling should theoretically close the gap, but silver recycling is constrained by physics and economics. Electronics contain silver in micro quantities that are difficult to recover economically. Medical applications often destroy the metal entirely. Solar panels, one of the largest sources of new demand, trap silver in a form that cannot be reclaimed for 25 to 30 years. The recycling industry supplied only 193.9 million ounces in 2024, far below what is needed to offset structural deficits. These limitations feed into a growing supply imbalance. The Silver Institute confirmed 5 consecutive years of deficit, with 2021 to 2024 alone erasing 678 million ounces of above-ground stockpiles, equal to nearly 10 months of global mine output. Deficits of this scale are unprecedented in modern silver markets. They reflect a system consuming metal faster than new supply can replace it. Exchange inventories reveal the same stress. COMEX registered silver, metal eligible for immediate delivery, has collapsed from roughly 80 million ounces in 2021 to levels that represent a tiny fraction of global annual consumption. At peak stress points, market leverage reached 100 to 1, with more than 100 paper claims for every physical ounce available. Such ratios function only when holders never request delivery, but in a tightening market, that assumption weakens. Even national vaults are not insulated. London's LBMA inventories continue to trend lower, reflecting broad physical drawdowns. At one stage, only 276 million ounces remained as unallocated float, a dangerously small buffer for a system built on continuous industrial consumption. The effect of these constraints is simple. Supply cannot respond to higher demand in any meaningful time frame. Mining cannot scale within years. Recycling cannot accelerate without technological breakthroughs. Substitutes cannot replace silver without sacrificing performance in solar, electronics, or EVs. This rigidity is what transforms tightening markets into strategic opportunities. Because when a metal cannot be produced in greater volume, the only way to secure future supply is to buy what exists today. China understands this, and its accumulation strategy gains leverage precisely because the rest of the world cannot create new supply quickly enough to compete. The stage is set for wider market consequences that intensify as China removes more metal from the global system. China's accumulation does not occur in isolation. It sets off a chain reaction that shifts liquidity, pricing power, and industrial risk across global markets. Each adjustment magnifies the scarcity already forming in the physical system, and together they redefine who controls the world's most important industrial metal. The first reaction appears in the banking sector. As physical inventories tighten, financial institutions begin retreating from silver distribution. 4 major South Korean banks suspended silver sales indefinitely, citing difficulties sourcing metal. This is not typical behavior for institutions with broad international access. It indicates shortages emerging at the wholesale level, not retail. When banks step back, the signal is clear. Supply is no longer guaranteed. China took an even more aggressive step. It restricted citizens from buying precious metals through banks, a move that channels more physical silver towards state-directed reserves. The decision effectively consolidates national control over remaining inventory. Retail demand is not suppressed for stability. It is suppressed to ensure the state absorbs every available ounce. These measures deepen market fragmentation. Western exchanges continue operating under a leverage-heavy paper system, while Eastern markets shift toward physical accumulation and state hoarding. The divergence pushes pricing power away from New York and London and toward Shanghai, the region where the real metal increasingly resides. The second chain reaction unfolds in market structure. Backwardation, where spot silver trades above futures, persists as industrial buyers prioritize immediate delivery. Physical premiums rise. Dealer inventories thin, At times, spot silver has traded meaningfully higher than futures, a sign that the market no longer trusts long-dated promises. This behavior mirrors previous commodity squeezes, including palladium in the 2000s and nickel in 2021, where shortages forced futures markets into defensive halts and rule changes. Stress points are already visible. The CME halted trading in late 2025, citing a cooling failure during a spike driven by tight liquidity. Such events rarely reflect technical problems alone. They tend to surface when large counterparties face delivery pressure they cannot meet. As China absorbs more physical metal, these disruptions risk becoming more common. Market leverage magnifies the effect. COMEX at one point carried over 100 paper claims per registered ounce, a structure that collapses quickly when even modest delivery requests increase. The system functions only if most participants settle in cash, but industrial users, especially in energy and technology, increasingly demand real metal, not paper. The third chain reaction strikes manufacturing. Western solar producers, electronics firms, and EV manufacturers rely on stable silver supply at predictable prices. But as China tightens its control over upstream silver flows while also dominating downstream production, foreign manufacturers face a single point of vulnerability. If China controls both the inputs and the outputs, global supply chains become dependent on its internal priorities. Meanwhile, other nations are reacting to China's moves. Russia formalized silver as a strategic reserve asset. India ramped up imports to record highs. Turkey, Poland, and others increased precious metals accumulation. The outcome is a geopolitical race, not for influence, but for resource security. The final chain reaction forms in the financial markets themselves. As inventories fall and sovereign accumulation rises, futures contracts risk detaching from physical availability. A paper market backed by insufficient metal cannot maintain credibility once shortages become visible. When that moment arrives, the adjustment will not be gradual. It will be a break, the same pattern that ended the Hunt brothers' accumulation in 1980 and crushed leveraged traders in palladium 2 decades later. China's strategy accelerates this timeline. By quietly removing metal from global circulation, the country increases the probability that a supply crisis arrives sooner, not later. And when it does, nations and industries that depend on open market pricing will face the correction most sharply. What begins as accumulation eventually becomes leverage, and China is positioning itself to hold that leverage at the exact moment the world enters an era defined by electrification, energy transition, and resource scarcity. China's accumulation signals a deeper shift in how nations prepare for the next phase of global economic competition. Silver is no longer only an industrial input or an investment hedge. It is evolving into a strategic resource that underpins the technologies defining the 2025 to 2035 decade. And China appears determined to secure this advantage before scarcity becomes visible to the broader market. 3 forces explain why China is accelerating its position now. The first is energy transition dominance. China leads the world in solar manufacturing, EV production, and battery systems. These industries cannot expand without silver. Government-backed capacity additions continue at record pace. Forecasts show photovoltaic demand rising toward 200 million ounces annually by 2026, more than doubling from 2020 levels. As global climate policy tightens, silver becomes the metal that determines whether renewable energy goals are achievable. Control the silver, and you control the speed of the transition. The second force is supply chain nationalism. Fragmentation in global trade is accelerating. Restrictions on metals, semiconductors, and energy components have become routine tools of geopolitical leverage. Russia's silver reserve policy, India's record imports, and Western banking withdrawals indicate that nations are moving toward resource self-insurance. China understands that supply reliability is more valuable than price. By centralizing accumulation and limiting domestic retail access, Beijing ensures the state, not private investors, captures available physical metal during periods of tightening. The third force is monetary hedging against long-term currency risk. Silver behaves differently from other industrial metals because it also functions as a monetary asset. During periods of monetary expansion or fiscal strain, it trades alongside gold as a store of value. With global debt climbing and major central banks shifting toward looser policy, Evident in market expectations ahead of the December 2025 Federal Reserve meeting, pressure on fiat currencies could intensify. In such an environment, a nation holding large silver reserves gains insulation from volatility in the global financial system. These forces point to a future where silver's role expands beyond industry. If China accumulates 60 to 80% of available export-ready silver, pricing power could migrate from Western exchanges to Asian physical markets. A region dominating both production and consumption would naturally begin setting the benchmarks. That transition is already visible in the gold market. Silver may follow. The implications for the West are significant. Solar developers, EV manufacturers, and defense contractors could face periodic shortages or chronic price instability. Premiums for physical delivery may rise sharply during stress periods. Futures markets, already stretched with leverage ratios exceeding 100 claims per ounce, risk credibility loss if delivery requests outpace supply.
A market built on paper liquidity cannot withstand a world where nations compete for physical control.
The longer-term price implications are equally important. Historical ratios between gold and silver suggest mean reversion could lift silver toward levels far above current pricing as structural deficits persist. Analysts projecting $75 to $90 silver by 2026 consider only moderate tightening. More aggressive scenarios, where deficits continue and sovereign accumulation accelerates, point to much higher levels. These scenarios are not speculative. They are mathematical extensions of supply constraints documented across multiple years. As inventories approach critical thresholds, the adjustment may not be gradual. Commodity markets rarely reprice slowly when structural deficits intersect with geopolitical strategy. They break, they reset, and the physical market, not the futures market, dictates the new equilibrium. China understands this trajectory. Its policies reflect anticipation of a world where silver scarcity becomes a defining constraint on technology, energy, and manufacturing. By accumulating now, quietly, steadily, and at scale, China positions itself not just to avoid the shortage, but to shape its outcome. The big sweep is not about today's price, it is about tomorrow's leverage. Silver is no longer just an industrial commodity, it has become a strategic asset shaping the next phase of global competition. China understands this shift earlier than most. Its accumulation is not reactive, it is preemptive, and it reflects a worldview where technological strength, energy security, and monetary resilience converge around a single resource that cannot be manufactured, substituted, or scaled on demand. The data shows a market entering structural scarcity. Inventories are thinning, deficits are compounding, supply is rigid, demand is accelerating. In this environment, control over physical metal becomes a form of leverage, not just for industry, but for national policy. That leverage grows each year as silver embeds deeper into solar expansion, electric mobility, advanced electronics, and defense technologies. What China is building is not a position, it is an advantage, one that becomes more powerful as global supply chains tighten and as paper markets lose credibility to physical reality. The big sweep is not about outperforming investors or timing a commodity cycle. It is about shaping the economic architecture of the next decade. For the West, the message is clear. The world is shifting from a system defined by abundant inputs to one shaped by constrained resources. Nations and industries that treat silver as interchangeable risk being outpaced by those that recognize it as foundational. China has already made that determination. Others are only beginning to see the implications. In the end, control of silver is control of the technologies that power modern economies. And China is positioning itself to hold that control as the rest of the world awakens to the scale of the coming scarcity.